Okay, we're doing some exercises from chapter 4 of the Phillips 7e book. This is talking about closing and adjusting. Adjusting entries first and then closing. So first what we'll do is exercise 4.3, and I believe it's on your textbook. I'm using the online textbook just because it's easier for me to show you if I'm using it. But if I was actually doing the problems, I would be using the physical copy of the textbook. So if you have the physical copy, just go ahead and use it. Exercise 4.3, I believe it's on page 188. We're just going to work through this and give you some demo so you can see how these work. The more you work with adjustments and closing, the easier it gets. So don't give up if it's a little struggle at the beginning about trying to figure out what we're doing. Okay, so the first thing is this problem says during the month of September, Texas Go-Kart Company had the following business activities. It gives you 4 transactions that happened. The requirement is first prepare the journal entry, if any, required to record each of the initial business activities on September 1. And then prepare the adjusting journal entry, if any, required on September 30th. So this is the reporting period of 1 month. It gives you a little idea of what adjustments will be needed. If you record something and it's not time to show it as revenue or expense initially, then at the end of the period, when you start to do a financial statement, you have to do an adjustment in order for it to be correct. Otherwise, the items that you put in as originally as deferrals and accruals could have a different value at the end of the period, and you would need to adjust them to correct, or your financial statements would be misstated. Okay, so the first transaction, on September 1st, we paid rent on the track facility for 6 months at a total cost of $12,000. So on September 1st, let's see if I can get to the right place here. We made an entry for $12,000. We paid the cash, but it was for 6 months. So it wasn't for the current period. It wasn't going to be rent expense currently. It's going to turn into rent expense eventually, but we need it to be in the correct month. So on the 1st day of September, we put it all to prepaid rent. Just like when you pay a big insurance premium for a year or for a quarter, you put it to prepaid insurance, and then you just adjust it at the end of the period. When you start to make a financial statement, you adjust it to correct. So what you're trying to do is adjust your balance sheet number to the correct number. At the beginning of the period, though, when you're paying for these things, you just show the entire amount as deferred. So prepaid rent deferred for $12,000. Then at the end of the month, on September 30th, when it's time to do the financial statements, you're going to shift some of this cost over to rent expense from prepaid rent. And the way you can tell how much is you look back and say, how much was that $12,000 paid for? Well, that was paying for 6 months. This is 1 month because it's September 1st to September 30th. So 1/6 of $12,000 is not prepaid anymore. It's actually was an expense for the month of September. So we're going to debit rent expense for $2,000, which is 1/6 of the total, and we're going to credit prepaid rent so that at the end of the month, when you start to do financial statements, only 5 months of it will the effect is that only 5 months of it remains in prepaid. So if you did a T account for prepaid rent, it would show that debit of $12,000 and then the second entry, the credit of $2,000. So you'd have a net $10,000 showing up as prepaid rent at the end of the first month. That is just the 5 months worth of rent at $2,000 a piece. So you're just adjusting it to correct. So don't overcomplicate this. Don't try to make it into some magical thing because it's not. It's very methodical. Okay, so B. On September 1st, we received $60,000 for season tickets for 12-month admission to the racetrack. So obviously, when it tells you there's this long period of time, you're going to need to show it as as an unearned. They gave us. I'm trying to say we're a go-kart company, so we received this money in advance for 12 months of admission. So we're going to show it as an unearned when we record it initially. They call it deferred revenue, which is exactly the same thing. Unearned revenue and deferred revenue are the same thing. And so we debited the cash for the whole amount and we credited deferred revenue. We could have said unearned revenue. Either one's fine. Then at the end of the month, we look back and we say, now how much was that $60,000 for? How many months did they pay for? 12. So 1/12 of it, we're going to shift because these adjustments, remember, are just a toggle between the balance sheet and the income statement. We're looking at what's on the balance sheet, and it says a liability deferred revenue of $60,000 at the end of the month, September. But it's not actually right anymore because that was 12 months worth of deferred revenue, and only 11 months of it is still deferred because now we've let them use up their admission for 1 month. September is already passed. So we actually have revenue for the month of September in the tune of $5,000 because it is 1/12 of that 60. So what, in order to affect this correction, we debit the deferred revenue account and we credit sales revenue to shift it or toggle 1 month of it over to the revenue account so that the deferred revenue account now only has 11 months of it in their balance. So this is just trying to true it up, basically. It's all we're doing. Correct it as of the last day when we're about to do a financial statement. It's not always a month you're dealing with. It could, the period that you're adjusting is sometimes the whole year. So whenever you do financial statements, if you do the financial statement at the year end, then whatever period has not been adjusted yet, that's the part you look at. So if this had been the end of a year, you would look at December 31st, say, then you would look at how many months had expired by the end of December, and that's how many you would shift from the unearned account over to the earned account, which is the revenue account. All right, so now the C one. On September 1st, we booked the racetrack for a private organization that will use the track 1 day per month for $2,000 each time to be paid the following month. The organization uses the track on September 30th. Okay, so this one is kind of tricky because if you read it 2 or 3 times, you'll figure out no cash took place at all. It's not a deferred revenue because they didn't give us cash. So it's not actually a transaction on September 1st. It's just an appointment or a reservation they made in our system. So no journal entry on September 1 because nothing happened. We didn't have anything to record for revenue, and we didn't have anything to record for cash we collected. So on September 30th now, we have an accrual because they said they would pay us the following month. So now we can show the revenue, and we're going to record it as accounts receivable, which is an accrual of the revenue. They didn't give us the cash yet. They're going to give us the cash in October. So now we've recorded it just with a normal accrual at the end of the month. We had provided them the service, and they are going to pay us the following month. On a transaction D, September 1st, we hired a new manager at a monthly salary of $3,000 to be paid the first Monday following the end of the month. Okay, again, it's a little tricky because if you look at it, no cash moved on the day on September 1st. We just made a contract with this guy that we're going to pay him after he provides the service. No cash moved and no expense happened yet as of the day that we made the contract. So no journal entry. Then on the last day of the month, he has provided the services for the month of September, and we're going to owe him in October for his salary. So we have to accrue his salary. We're going to show the salary expense with a credit to salaries payable because we haven't paid the cash out yet. So it's September wages that he provided that we need to record as a cost. And so that's why we're debiting the salaries expense, but we didn't pay it yet. So we're going to show it as salaries payable. That's the nature of accrual. So these journal entries showed us a little bit of deferrals and a little bit of accruals. All right, so that was E43. Let's just jump a little bit further to E416. Just scroll down here. 14, 15. Okay, wait, this is page 193. 194. It's on page 194, I believe, in your textbook. E416. So I got a worksheet for it. So what we've got is Mint Cleaning Company prepared the following unadjusted trial balance at the end of its second year of operation ending December 31st. Assume the amounts are reported in thousands of dollars, but we're just going to keep them as they are rather than putting 3 zeros behind each one of them. So you see they had a balance. They showed the balance in each of these accounts. What they're asking us to do is they gave us this data, other data not yet recorded. They gave us 4 things that might need to be adjusted. And then the required say, prepare the adjusting journal entries for these 4 A, B, C, D. And then using T accounts, determine the adjusted balances for each of the accounts and prepare the adjusted trial balance. And then they're asking you how much would it have changed net income if you didn't make these adjustments. So what I have done is I took these account balances they gave me in the trial balance and put them into a T account already. So all these beginning balances are already there. The source of those is from the data set. They gave us these balances here. I just transferred them as a beginning balance in all the T accounts. So now I'm going to go to the transactions that might need to be adjusted, or actually these are the positions that we have that might need to be adjusted. So let's see, the first one, A, insurance expired during the year. So if they give you an expired insurance, they're trying to say you need to record this as an expense. The insurance that's prepaid is unexpired. So if insurance is expired, that means it's expense. So what they want you to do is to debit insurance expense and credit prepaid for that amount. And it's 5, which is 5,000, but we're just going to do it in the same format they have it. So that, I think I already posted this entry. Look here. This is a journal. This is an adjustment. I'll make these. I'll just make it coincide with that. And the prepaid insurance took the credit. Insurance expense took the debit. Seriously, why did you do that? Where's insurance expense? Okay, I see it. We're going to record. I really wish I would stop taking the wrong piece. Sorry. It's not where they put it. Sorry. All right, eventually I'm going to get it. Let's go yellow with this whole thing. That's the A transaction. It just doesn't want to do it. Come on, can do it. Nope. Okay, don't worry. We don't have to have it yellow. Okay. B, depreciation expense for the year. Anytime they tell you the depreciation, they want 1 entry, a debit to depreciation expense and a credit to accumulate depreciation. It's not going to change. Now later in a later chapter, we'll learn how to calculate depreciation. We'll have to configure, decide how much should the depreciation be. But for now, for quite a while here, they're going to give you the amount of depreciation. And all you have to do is debit depreciation expense and credit accumulated. They gave you the amount, so nothing to that. Then the third entry is salaries and wages payable. So you have to accrue whatever salaries are due at the end of the month, and that's what they're doing. They give you the amount. So again, it becomes a piece of cake, nothing to it. And then D, income tax expense. They want you to accrue income tax expense, which is due after the period ends. So you know it's going to be a payable involved. So these 4 entries were the adjustments based on this information. You see how they look exactly like what the transaction says they are? That each one of them is just what it says. So it's very straightforward. So we're just trying to get you comfortable with how to make these adjustments. So the first requirement was that we prepare the journal entries. So we just did that. Then using the T accounts, post those entries so that we can prepare an adjusted trial balance. So we're going to take these entries and make sure they're A, we've already posted with a credit to prepaid insurance and a debit to insurance expense. The depreciation entry, B, we're going to debit depreciation expense. We're going to credit accumulated depreciation. Then C, debit salaries and wages expense, credit salaries and wages payable. For the $7. Then the last one, income tax expense takes a debit. And it's down here. Income tax payable takes the credit. So we posted all 4 entries, and then we look at these T accounts and say what needs to be adjusted. We're just going to tally up any that we've changed. Well, cash didn't change, so it's, and neither did accounts receivable. So those balances are the same as they started being. Prepaid insurance started out being 6, and it had a credit to prepaid for 5. So that means it's now a balance of 1. Equipment didn't change, so it still has the same balance it started with. Accumulated depreciation had 0, and we added 4. So it has a balance of 4 on the credit side. Accounts payable didn't change, so it's still the same as it was. Stockholders' equity didn't change yet. No, it didn't. They didn't tell us anything got issued. Salaries and wages payable and income tax payable changed, but when we already pulled those balances down. Retained earnings hasn't changed yet because we haven't closed out yet. Sales revenue, sales and supplies expense didn't change. We've already pulled down the totals for these last 4 expenses. So now these are the ending balances. Whatever the last number is for each account is the balance we're going to pull into the trial balance. So you see cash has a debit of 38, accounts receivable a debit of 9, prepaid insurance a debit of 1, equipment a debit of 80. That's all of the debit accounts for assets. So we'll take those. Those are the numbers I just mentioned. Then going back up, we look at accumulated depreciation has a credit balance of 4, and accounts payable has a credit balance of 9. You notice how there could have been entries, debits and credits to these accounts, but we are only pulling the ending balance. Whether it's if it's a debit, we pull it to the debit side with nothing on the credit side. For example, look at prepaid insurance. I only entered 1 in the debit side. Look at prepaid insurance account though. I'm going to get rid of the yellow just so we don't let that confuse us. On prepaid insurance, some students like to write 6 on the debit side and the 5 on the credit side, or maybe even the 1 on the debit side and the 5 on the credit side. But all you're doing is pulling the ending balance, whatever it is. You don't put anything on the credit side for these debit balance accounts. Okay. All right. So then we're just going to pull these salaries and wages payable, income tax payable, and common stock and retained earnings. These 4 numbers, 7, 9, 76, and 4. We'll drop those in our trial balance. This is the adjusted trial balance because it's the balances after the adjustments were made. So then that's what we've done is we've got all the asset accounts. And when you look at these, the debit balance accounts plus accumulated depreciation are all considered the asset accounts. Accumulated depreciation is a contra asset, meaning it reduces the asset, but it's still in the asset section. Then the liabilities that we pulled, we pulled all these payables. And if we had an unearned or deferred, we would have included it also as part of the liabilities. Those are all liability accounts. Then we have these equity accounts. We pulled those next. And if we had dividends, we would pull it right after that. Dividends would land right under retained earnings. So then once we've got all the balance sheet accounts, which is everything we've done so far, then we would start listing the revenue expense accounts. And so that's what's coming next. We look for revenue accounts in these T accounts. So that would be the sales revenue number right there for $80 credit. Then all these 5 expenses, we would pull supplies expense, salary expense, depreciation expense, insurance expense, and income tax expense. Pull those balances in. First, we'll take this credit for the revenue account. Then we'll pull all these debit balance accounts. And remember, when you're pulling trial balance, you don't try to think, should that be a debit or a credit? No, you just look at the T account and say, what is the ending balance? You don't try to rethink it, which should it go on. You look at the balance in the T account and pull it directly from there. So now we've pulled everything that we had in our T accounts. And now the next thing you do is you hold your breath as you add up the columns and see, do the debit column totals equal the credit column totals? In this case, I already checked it, so I know it does, 189 for each way. Now the adjusted trial balance shows the actual values that we can use on our financial statements. So this is ready. Since it's an adjusted trial balance, it's ready to do financial statements just like that. Okay, so the requirement 3 just asks us, by what amount would net income have been understated or overstated had the adjusting journal entries not been recorded? And so all that means is when you made these adjustments, what did you change? So you see what we changed about the net income. We added an expense in every case. Now, sometimes when you do adjustments, you are changing the revenue as well. But this one, we only changed the expenses. We changed it by 5 and 4 and 7 and 9. So that's 9, 18, $25. We changed it. We added extra $25 expense. So without the journal entries, net income would have been overstated by $25 because these expenses, these 4 expenses we posted, would not have been reported. Okay, so that is the second exercise. The third one is in the problem B set. So I'm going to go back out to the B set, group B problems. PB41, it's just this first one here. It's on page 201 in your textbook. This is the last problem that we have on this chapter out of the textbook. This is Regis Corporation, operates hair salons under various brand names, including Supercuts, Magic Cuts, and Style America. The following is a simplified list of accounts and amounts in millions reported in the company's accounts for the year end June 30th, 2019. So it talks about, it shows you in alphabetical order these different accounts. They want you to pull them, and I'm not going to take the time to alphabetically point out where they're coming from. Just trust me, whenever you do it, you're going to have problems just like that for your homework. You're just going to go through one at a time. And your first thing, the best way to approach it would be to look at them and see which ones, is it a liability, equity, asset, liability, equity, and then on the equity section, is it a revenue or expense or a dividend? So if you mark those, then you can just pull in order of liquidity, all the assets first, then all the liabilities, then all the equity, then dividends, and then the revenue accounts, then the expense accounts. And so once you have them pegged or which they are, it makes it a lot faster to move them over here. But in the meantime, I'm just going to go ahead and pull these. They are exactly the same amounts that are in that schedule and accounts, but it's just they needed to be shifted into the correct order for the trial balance. So once you sort it all out, you wind up with debit balance accounts of 2,097 and credit balance accounts of 2,097. So when they come to the same number, you can congratulate yourself and say, yes, I conquered it. It worked. The trial balance is in balance. That means I didn't accidentally switch something to the wrong side, or I didn't make a wrong assumption about what type of account something is. Because you notice on all these accounts, they don't actually tell us whether it's a debit or credit balance, because they assume you're learning or have learned what the normal balances are for each of these types of accounts. So you're able to just put them in the trial balance on the correct side, because you know accounts payable is a liability and it always has a credit balance. The only way it would not is if something were bad wrong. Okay, so we have a trial balance. Let's look at the directive and see what else they told us to do to it. They said in the requirements to prepare an adjusted trial balance for June 30, prepare an adjusted trial balance at June 30. And they ask you, is the retained earnings balance of 280 the amount that we reported on the balance sheet? No. This retained earnings that shows up on an adjusted trial balance is the beginning of the year retained earnings, because these accounts have not been closed out yet. These revenue and expense accounts would have to be dumped into retained earnings in order to get the ending retained earnings balance, right? And so that's what they want you to do. So number 2, they want you to prepare the closing entry required on June 30th. You see, they don't have dividends, so they're not going to need to do that piece, the final step of the closing, in this case, because there's not a dividends balance. And the tip says company reported a net loss of $14 this year, so the closing entry will need to debit, not credit, retained earnings. So I mentioned this in an earlier video. This occasionally happens that the company would have a loss where their expenses exceed their revenue. In that case, the closing entry would just, you still can do it just the same way, but what you're doing is you're making the entry balance on whatever side it needs to with retained earnings. And so when you do that, it shifts the retained earnings to the left, to the debits column. And then they want us to prepare a post-closing trial balance after we close out. Just a little tip, a post-closing trial balance is exactly like an adjusted trial balance, except the revenue and expense are gone. All this is exactly the same, the part I highlighted here, on a post-closing trial balance. The only thing that's different is the retained earnings now includes the amounts for all these revenue and expense accounts. So all these numbers are the same. The retained earnings number would be different because it would include the summary of all these revenue and expense accounts. So because they get dumped into it. So let's do the closing entry. We use the adjusted trial balance as the source of the closing entry. So you just look at it and decide, okay, I've got service revenue. It has a credit balance. If I want to dump it out and reset it for a new period, close it. In other words, how do I do that? If any account has a credit balance and I want to bring it to zero, what would I have to do? Can I make a journal entry for a negative credit? No, you don't ever put negative numbers in a journal entry. So if you need to make that balance go down to zero from where it is, you have to move it to the opposite side. So if it's a credit balance for 1070, I have to debit it in order to clear it or close it. So that's what I'm about to do. And then the other part of the entry is the expenses right now all have debit balances, as you see right here. Every one of those individually has to be credited in order to close them out. So that's what we're going to do. Our journal entry is just going to be, they're using the two-step method. So since they don't have dividends, it's actually a one-step method this time. So what they're going to do is take every revenue and expense account and reverse its balance. They didn't do this entry right here initially. They did all the rest of the entry except the retained earnings first. Now, in my opinion, it's easiest to, if you're going to do the combination, the two-step method for the closing, when you close revenue expense, it's easiest to do the revenue accounts first and leave a blank line for your retained earnings, or just put the word retained earnings. I usually leave a blank line because I want to indent it if it's a credit balance. So I leave a blank line after my revenue accounts, and then I close all the expense accounts. So then when I tally up the total of the credits and the total of the debits, I'll be off by some amount. I won't balance. The amount I need to balance is the amount that's closing to retained earnings. In this case, when you add up the credit balance accounts, you're not going to come up to 1,070 like the debit balance shows. You're going to come out to 1,084. And so when you do, it's telling you if the total of all these credits is 1,084, that's telling you that you need to post retained earnings as a debit for that extra 14. So because the two sides have to balance, all the debits has to equal all the credits. The way they balance is with the entry that's being posted to retained earnings. Because what you're really doing is, like we did on the four-step method, you're really closing revenue and you're closing expenses. And the net of the two is what's being posted to retained earnings. Okay. So once you post all these, what happens is it wipes out every balance of the income statement accounts. All revenue is gone. All expenses are gone. They are now part of retained earnings. So when you do your post-closing trial balance, it's a piece of cake to make a post-closing trial balance. You list everything down to, I don't know how far to go down yet until I see them. Everything down to retained earnings. I'm just going to go ahead and reveal it since I don't know where to stop. And when you get to retained earnings, you post your new balance. All the rest of the accounts are exactly, all the rest of the balance sheet accounts are exactly the same as they were in an adjusted trial balance. We haven't changed any more of those. Closing doesn't affect balance sheet accounts with the exception of retained earnings. So retained earnings changed and all the revenue expenses are wiped out. So in actuality, your post-closing trial balance wouldn't even have a list of the revenue expense accounts. It would just end right here at retained earnings. This would be your post-closing trial balance right here, without the entry that say 0 on all these revenue expense. They're just trying to make sure you know those balances are gone. There's nothing there. Because and that's the end of their fiscal year. When they start the first day of their new fiscal year, they want those revenue expense accounts to have 0 balances so they can start again tracking what's happening in this period. Okay. So that's all of this one. That's the 3 exercises we'll do for out of the chapter, and I'll post some other videos of examples. Okay.